Well, I think stocks are holding up because the economy's actually doing better in the face of this war.
One of the most striking points Tom Lee makes is that the economy, and by extension the stock market, is holding up because of the very conflict that many assume would weaken it. This seems counterintuitive. War typically brings instability, higher costs, and uncertainty. But in this case, Lee highlights a key factor: government spending. With defense spending potentially reaching $30 to $60 billion per month, this acts as a powerful economic stimulus. In simple terms, money flowing into defense contractors, logistics, and infrastructure boosts corporate revenues and supports employment. At the same time, rising oil prices, while painful for consumers, have a surprisingly limited net impact. A $20 increase in oil translates to roughly $12 billion in additional monthly costs for households. Spread across millions of families, that's about $50 to $100 per month per household. Lee is careful not to dismiss this burden, but his core argument is that it's not large enough to derail the broader economy. When compared to the scale of government spending, the net effect still leans positive for corporate earnings. This is a crucial insight. Markets don't react to headlines, they react to net economic impact.
They will say the ever bullish Tom Lee was ever bullish, but you were also right. I mean, is there anything that is going to stop stocks right now, Tom? Because they just keep going up.
Hi, Brian. How are you? Well, I think stocks are holding up because the economy's actually doing better in the face of this war. And I know it sounds counterintuitive, but part of it is the defense spending, at $30 billion a month, and it may end up being, $60 billion a month. That's actually quite stimulative to the economy. This $20 rise in oil is only adding about $12 billion a month to the household burden. So on sort of net basis, the war is actually helping earnings right now.
Yeah, and it's hard to admit this because I do know that gasoline prices for a lot of families out there are a major cost, especially with all the other inflation of the last 5 years. But with car mileage per gallon up, if you do the math, you're looking at maybe $50 to $100 per family per month in extra cost right now. Again, it's not insignificant. I want to be mindful of that. But it sounds like you're saying that is not enough to damage the economy and thus damage corporate earnings and the markets.
That's right, Brian. I mean, nobody wants the U.S. to be at war.
No.
And of course, we're caught in a fog of war. I do think one of the things we have to remember, even like going back to World War II, the stock market bottomed in May 1942, 5 months after the U.S. entered the war, but before any U.S. troops were even on the ground, either in the Pacific or in Europe. So the market does have a really good way of sort of discounting outcomes. And I think the reason it's going up is I think we're going to end up with a favorable outcome, which I can't say I know why, but that's what it looks like.
Well, and things could change, and I want to get your take on that because let's pray for peace and hope that things tone down. We did have a power poll. I wanted to hear from our viewers and all of our ex-followers and whatever about how they feel. And we asked a very simple question, Tom. It was, what matters most for the markets right now? Is it the Iran war? Is it corporate earnings, which are starting to roll out? Or is it interest rates? People can vote now by clicking on the QR code. How would Tom Lee vote on that?
Well, I would say that of those three, only one can create tail events on both sides, which is the Iran war. So I think that the most important thing to watch and to really be mindful of is the war.
Okay, because are the other ones already known? Earnings for the first quarter won't be that affected because the war began basically at the beginning of March. So we only have 1 of 3 months where you've got some energy disruptions. The second quarter numbers will be slightly different. So with that in mind, how closely are you and your team going to be watching first quarter earnings versus second quarter earnings, which will maybe fully price in much of what we're seeing?
Yeah, Brian, we're going to watch both because, as you know, some groups in the S&P are going to be affected immediately by higher transport costs or availability of commodities. And so we're going to get a pretty good picture of sort of that disruption that is working its way through. And of course, that gives us a hint to the inflation shock that's coming. But all that being said, as you know, the world and the U.S. has been dealing with a series of shocks over the last 5 years. So in some ways, I'm not saying the market's becoming desensitized to it, but it's learning to not go into a full-blown panic because of it.
You still, we're going to wrap it up, Tom. I think you still have your 7,700 price target on the S&P, and some individual names. You got the One Oak, Texas Pacific Land, Quanta. Sounds like you're all in on the energy expansion and growth story.
Yes, and I think it's highlighting an important theme over the last few years, which is that every country wants three types of security. They want energy security, they want sovereign security, and they want cybersecurity. So I think all of those are going to be good areas for where spending grows, and stocks should do pretty well.
Now, let's connect Lee's macro view with the technical perspective discussed in the latter part of the transcript. One of the most important concepts here is bottoms are events, tops are processes. Market bottoms tend to happen quickly, sharp sell-offs followed by rapid recoveries. But tops take time. They form through a series of rallies, pullbacks, and new highs that gradually weaken the overall structure. This is where things get tricky for investors, because during a topping phase, the market can still make new all-time highs. In fact, that's often part of the process. It draws investors back in, reinforcing bullish sentiment even as underlying conditions deteriorate.
Now, let's go ahead and jump in. So, a couple of months ago, we put out this video. Stocks to drop 10% soon. And it was essentially the week that the all-time high was created, at least the current all-time high. And following that, the stock market dropped about 10%, right? About 9.8%, but roughly 10%. Now, in that video, what we said is that after we get the 10% drop, there will likely be another rally. And it very well could go back to an all-time high. It doesn't have to, but a lot of times it does at the end of business cycles. And the reason for that is because it keeps people constantly second guessing, like what's actually happening. Okay? Now, I want to explain this in a way that makes the most amount of sense to me, and hopefully you can kind of understand where I'm coming from. As I've said before, topping is a process. Bottoming is normally an event that happens very quickly and it's over. Even look at how this has happened, right? Look at 2026 so far, how that top there was a long process, but the bottom, single event. In 2025, topping was a process, the bottom was an event. You see the difference? Okay. Now, here's where it gets interesting, and I think a lot of people that watch this channel are at least somewhat aware of what Bitcoin is doing. We do talk a lot about Bitcoin. It is one of my favorite assets to talk about. I just think it's in a bear market, which is fairly normal. But let's look at Bitcoin, and I think Bitcoin will give us insight into how it's playing out in the stock market. And even prior into business cycle scenarios for the stock market could give us insight into how this is going to play out. If you look at Bitcoin, one of the things to note is how in the bull market, when we set highs, the bull market structure was intact as long as we did not go below those highs on the next pullback. Okay? So think about how the drop that Bitcoin had, back in 2024, how it was still well above the sort of this range, and it was also above that local high with where the ETF launched. So you could argue that the structure of the bull market remained intact. We came very close to sort of destroying the structure of the bull market when we got the pullback in April of 2025. But if you go back to the videos I put out back then, what I said would likely happen was that Bitcoin would likely drop from late February to early to mid-April. And as long as we stay above the high from 2024, it would then likely yield another all-time high. And what you'll see is that the low in April of 2025 was 74,441. The high from 24 to 2024 was 73,757. So what happened is Bitcoin stayed above the prior high, and then it went to a new all-time high. But here's the thing. It got really close, and the next high that occurred was a distribution phase high that lasted several months. You see that? Yes, a new all-time high, distribution high. And then Bitcoin sold off, came back down to these lows, and then broke below that. So now we've sort of broken the structure of the bull market. Now we've set a lower low, in fact. So with the S&P 500, what I'm saying is, okay, we can make a similar argument, right? A similar argument where you have your high from 2023 and you have your high from 2024. And notice how the big drop Bitcoin had in 2025 did not take out that high right there. It did take out some of these other highs, but it was just a sweep. Then what happened is we had another high, another drop, but this drop was still above the prior one. Still above the prior resistance. Now we're going back up to the highs. We have seen this happen so many times. And the two main ways that sort of the ways that it historically plays out. One would be a hell of a lot easier to navigate, which is probably why it won't happen, but if it does, it would be easier. And before we go any further, I have to explain why I'm sort of operating under the assumption that this is distribution up here. Even at higher prices, I mean, the S&P could go well into the 7,000s and still be distribution. Bitcoin sort of topped at 109K in December of 2024. It just barely went above it later on to kind of draw people back into that $300,000 price prediction that a lot of people had. But all it did was draw people back in. And we can look at it now and say, all right, that was clearly a distribution phase. For the S&P 500, it's harder to say it when you're in the middle of it. But I would say Bitcoin is giving us a glimpse into what the S&P 500 is going to do. Because Bitcoin also did not take out a high here, right? It did not take out this prior high. It rallied to new all-time highs, remained in distribution for several months, and then eventually came back down. Look at the S&P 500. Now, are we going to compare this to 2022? We could, but one argument is that 2022 was not as late in the business cycle as we are right now. And so while comparing to 2022 can make a lot of sense, and maybe we'll do that in a future video, you could argue that comparing to the end of business cycles would make more sense. And the reason we're comparing to the end of business cycles, if you look at the liquidity risk metric, that looks like more of an end of business cycle regime, kind of like 2007, 2008, also somewhat similar to 2019. If you look at the stock market and we look at sort of the business cycle chart, the ITC business cycle chart, that also is reflective of a late business cycle environment. And what happens in late business cycle environments is exactly what you saw happen in 06 and 07 and in 2000, and the list goes on and on. You have these tops where you'll get these drops. You'll rally up to a slightly new all-time high, drop again, slight new all-time high. You look back on it, it was obviously distribution. When you're living through it, it doesn't feel like it. Okay.
Another critical layer is the idea that we are in a late-stage business cycle. Historically, this phase is characterized by multiple rallies and pullbacks, gradual weakening of market structure. Examples include the dot-com bubble, 2000, the pre-financial crisis period, 2007. In these periods, markets often drop, rally to new highs, drop again, rally again. Looking back, it's clearly a topping pattern, but in real time, it feels like continued strength.